Good afternoon. So let us continue with our discussion regarding subsequent to acquisition but prior to intercompany sale of merchandise and fixed asset. So this time we'll be focusing with three items: the amortization of excess, the impairment of goodwill, and intercompany dividends. So number one, the amortization of excess. And this will also be our working paper entry number 4 to continue with our 3 working paper entries mentioned on the previous video. So the excess which were identified on the date of acquisition will be grouped into 3. One is the excess on merchandise inventory. So excess, whether under or overvalued excess on merchandise inventory, that excess will be amortized depending on the sale of the merchandise inventory. In the absence of stories, merchandise were sold in year 1. So all merchandise were sold in year 1. So therefore, amortization of excess on merchandise inventory is in full in year 1, unless otherwise stated in the problem that only 40% or 60% or half of the half or 1/3 were sold this year and the remaining will be sold next year. So take note of that. In the working paper, we debit if the merchandise inventory has an undervalued excess, then in entry number 2, to recognize the excess, we debit merchandise as we credit investment account and NCI, assuming the subsidiary is partially owned. Then in entry number 4, as we amortize that excess, we debit cost of goods sold and credit merchandise inventory. Otherwise, if the merchandise inventory is overvalued, then in entry number 2, we credit merchandise inventory as we debit investment account and NCI. And entry number 4, in amortizing that excess, we debit inventory and we credit CGS. Then next group will be the depreciable fixed asset like furniture, building, machinery, equipment. So in amortizing the excess of depreciable fixed asset, example, in entry number 2, we debit building, we debit furniture, we debit machinery, which are all undervalued, as we credit again investment account and NCI. In entry number 4, as we amortize that undervalued excess, we debit OPEX, operating expenses, representing depreciation, as we credit furniture or building or equipment. Then the last group is excess attributable to land. Of course, we don't amortize the excess in land using remaining life as we do in depreciable fixed assets. They're amortized using remaining useful life. Take note, remaining useful life, not original life, not the years old, but the remaining useful life. But in case of land, we amortize land just like merchandise upon sale. Although unlike merchandise, it is assumed that all were sold during the year. If not the following year, land, we need an information when is that land in particular sold to outsiders. So again, amortization of excess. We amortize the excess, not in itself the equipment or the furniture or the building, but instead only the excess is being amortized in the working paper. Again, undervalued excess attributable to depreciable fixed asset, we debit OPEX, while if in case the undervalued excess is attributable to merchandise, we debit CGS. Otherwise, if overvalued excess in merchandise, we credit CGS. And if overvalued excess in depreciable fixed asset, we credit OPEX. Which means amortization of excess, whether over or undervalued in terms of in terms of merchandise, inventory, and depreciable fixed asset, it will affect the computation of CNI and NCNIS. CNI and meaning attributable to controlling and attributable to non-controlling, because we are amortizing the excess in relation to the assets of the acquired company. But it is another story whether we add or we deduct. So we will have a different lecture video about the summary of the different items, the normal questions regarding the consolidated items. Then next, the impairment of goodwill. So if goodwill is impaired, then there will be no problem if the goodwill is partial, because the impairment of that partial goodwill will always and will only be attributable to controlling. Otherwise, if the goodwill is full, then the impairment of that goodwill which is full is attributable also to controlling and non-controlling. So it is not automatically based on 80 or 20% or 70 or 30%, but instead, again, we use the determination and allocation schedule, and the impairment will be distributed between controlling and non-controlling depending on the goodwill, its corresponding goodwill. We will use the ratio of the goodwill as to controlling and non-controlling as the basis in distributing also the applicable or the appropriate impairment. So in the working paper, one of the working paper items, I will also put this in number 4 together with amortization. We debit impairment loss for the impairment of the goodwill as we credit goodwill. So 5th working paper item is the intercompany dividend revenue. So once the subsidiary will declare dividend, to the extent of the controlling interest, like 80% or 90 or 60%, in the books, in the separate books of the acquirer will debit, example, cash or dividend receivable, and credit dividend revenue following the cost method in the separate books of the parent. Of course, as far as the acquirer is concerned, that dividend recognized as revenue in its books came from outsiders, from a separate legal entity, not yet viewed as one. But in the consolidated FS, it is as if you declared dividends to yourself. So that dividend, which is intercompany, so we don't eliminate the dividend in itself, but the intercompany dividend. So since it is credited as revenue in the books of the parent, then in the working paper, debit dividend revenue to eliminate the dividend revenue for consolidation purposes. Credit dividends declared. So therefore, dividend declared by S company, because the logic behind is that dividends declared are deducted from retained earnings, and retained earnings is a credit normal balance. So to be able to deduct something from RE, that something is a debit balance. So to eliminate that debit balance, we credit dividend declared. But why dividend declared? Because again, remember that the retained earnings of S was already eliminated in entry number 1 through the working paper. So we use somehow an informal account title in the form of dividend declared to be credited, so that the consolidated dividend declared will only be the dividend declared by the parent. So also another debit is NCI or NCNAS. So therefore, in the consolidated SHE, being part of the NCI, it is only the dividends declared to outsiders will be reflected in computing for the NCNAS. Okay, so then moving forward, since our topic is subsequent to acquisition, in addition to what was mentioned, the amortization of the excess and the impairment of the goodwill, of course the intercompany dividend, we are to discuss the impact, the effect of those mentioned with the questions CNI controlling and CNI non-controlling. So when you say CNI, it is a total CNI. Then therefore it is attributable both to controlling and if in case the subsidiary is partially owned, non-controlling. So as to amortization of excess, as mentioned earlier, amortization is either added or deducted in computing for the CNI controlling and NC NIS, which is the non-controlling interest in profit. So if we are amortizing an undervalued excess, remember that we debited either CGS or OPEX. So therefore, the impact of CGS or OPEX being debited is they increase the CGS and they increase the OPEX. So therefore, if the question is CNI, controlling and non-controlling, it is something to be deducted. Otherwise, if we are amortizing an overvalued excess, then we credit CGS and we credit OPEX. While it will decrease CGS and it will decrease OPEX, the effect of which with the question CNI controlling and non-controlling is to add. So therefore, we deduct the amortization. If the excess is undervalued, we add if the excess is overvalued. That is for questions, in particular, CNI controlling and NC NIS. Of course, impairment is something to be deducted if the question is CNI controlling and NC NIS. But NC NIS will only be affected if we are if the impairment is in relation to a full goodwill. Otherwise, again, if the goodwill is partial, then the impairment is only a deduction from the CNI controlling. And NC NIS will not be affected if the impairment is about a partial goodwill. With regards to intercompany dividend revenue, it is a decrease from the CNI controlling only if the net income of the parent is a stated net income of parent, as in final net income. Otherwise, be careful if the problem will mention that the net income of the parent is from own operations or from separate operations. You don't need to deduct the intercompany dividend revenue if the given net income of the parent is from own operations or from separate operations, because in the first place, the dividend revenue is not yet included in that particular item. So let me check. Okay. So based on our handout provided specifically in problem 5, be careful with the impairment of the goodwill. We distributed the impairment of the total goodwill by preparing a schedule, and it is not to be distributed using basically the 80 and 20%. So take note of our solution on that particular problem. And so we will be in computing for the NC NIS. Therefore, to summarize, we start with the net income of the acquired company per books, and it is to be adjusted by working paper items like amortization. We add or we deduct depending if it is undervalued. We are amortizing undervalued excess, we deduct. Otherwise, if we are amortizing overvalued excess, we add. Then of course, the impairment of the goodwill only if the goodwill is full. Take note of then we multiply it to 20 or to 10 or to 40% to compute for NC NIS. But again, take note of the goodwill, its impairment, because we might be referring to a schedule, which is the allocation of the impairment through the ratio of the goodwill. Then in computing for the CNI controlling, from the total CNI, we can simply deduct NC NIS, or we can simply compute CNI controlling separately. So again, the net income of the acquirer per books, 100%. The net income of the subsidiary per books to the extent of the controlling interest, as well as the amortization, controlling interest, the impairment, controlling interest, and the intercompany dividend revenue which the parent received from the subsidiary. Okay, so please be guided. Then our next video will focus on intercompany sale of merchandise and fixed asset. See you.